When you're buying Alibaba, you're largely buying three businesses: the Chinese commerce platform, cloud computing, and their international business. In parts 1 and 2 of the analysis, we discussed how each of these segments are doing, but how exactly do they all fit together into a comprehensive valuation? That's exactly what we're going to dive into in this video. You're watching More Money, let's get it. Just a reminder that if you'd like to follow along with the free to download model, the link is in the description below. And I have tons of models available on different companies, so if this video gets like 2 likes, I'll release way more. So smash that like button, guys. Okay, so when looking at the China commerce segment, don't forget that we have 2 segments in here: the customer management segment and the China commerce retail other segment. Of course, the China commerce has the 2 largest brands, Taobao and Tmall, while the other segment has Sun Art and Fresh Hippo. You can see that overall this combined segment has been growing at close to 40% a year, but as explained in video number 1, I've never believed that the level of growth is sustainable over the next 5 years in this segment. So as you can see, the 5-year revenue growth rate for the combined segment in the base case scenario is being grown at 18.4%. And this is made up of the customer management segment, which I'm growing at 15%, and the China commerce retail other segment, which I'm growing at 24%. Some may argue that based on the comments given by Alibaba over the increased competitiveness of the online retail landscape, that we should bring down the growth estimate in China commerce retail even more. But personally, I struggle to bring it below that 12% low case scenario. Let me know in the comments what you think and where it should land. With the international business, they're doing very well, especially with Lazada seeing orders up 80% quarter over quarter. That being said, I'm still a little bit nervous over this segment and forecasting out at a much lower growth rate than they are seeing. This, in my opinion, may also be a bit too high, despite them massively outperforming those expectations so far. I personally worry about Lazada maintaining competitiveness in Southeast Asia, as they are not the leader in those markets. Also, Turkey is going through a massive currency devaluation, which could lead to political instability, which could also hurt Alibaba's Trendyol online commerce platform there. With their wholesale business, despite it doing well, I'm not going to increase my timid expectations here. China commerce wholesale has an average growth rate of approximately 28%, and I'm forecasting this out at 11%. The international wholesale business has an average growth rate of 22%, and I'm forecasting it out at 15%. I'm just being conservative here, as these segments can exhibit volatility. With the Xianlao logistics services, local consumer services, and their other businesses, I'm largely not increasing my midterm revenue growth estimates for them, despite the massive outperformance in Xinliao and the other segment. We know the regulatory issues have impacted local consumer services, i.e. Ele.me, in the year, but I'm more than confident that this business will pick up closer to that 18 to 20% revenue growth rate from the 15% that it's at today. So overall, core commerce revenue is forecasted to grow at approximately 19%. Contrast that with the 40% or so growth rate that it has achieved in the past. Once again, I never expected that historical growth rate to continue on this channel, and today's environment is a vindication of why you need to be conservative in your future forecast as a general rule. In my opinion, it's better to make a mistake of omission than commission when it comes to buying stocks. The other element of conservatism here is that since I gave you the model back in the summer, I've been forecasting a large margin contraction in the overall commerce business from an average of 46% to 25%, which once again in the current environment makes a lot of sense, as profitability was seriously impacted this year so far with investments being made in Taobao deals, local consumer services, community marketplaces, and Lazada. And as you recall, these investments actually decreased their profitability year over year. They did provide a reconciliation to show that net of the investments, they're actually up 3%. But what I think we really need here is guidance of what that spend will be going forward, so that we can adjust the overall profitability of core commerce. Until then, we'll just give them a haircut on the overall segment profitability like we have. And I'm fully willing to bring that profitability down even further until they begin communicating more effectively. So really, the ball's in your court, Alibaba. With cloud computing, I do believe that their revenue growth rates and profitability will pick up, but I actually gave them a haircut on both measures just because I wanted to build in a bit more conservatism here. Amazon is achieving margins of 30% on this business, but 5 years out, I'm giving Alibaba only 20%. So once again, just layers and layers of conservatism built into this model. Once you flow all of those estimates through down to the bottom line, we landed a valuation of approximately $300 a share, which uses a terminal multiple of 22.5 times earnings. And when compared with the current share price, we have an approximate 126% upside. In part 1 of this quarterly review series, I covered the core commerce segment business, which you can get to right here. In part 2, I covered cloud and the international business, which you can get to right here. Thank you very much, guys, and please don't forget to give this video a like, and I'll see you later.